Hi, good evening, everyone. Thank you for joining us at this webinar today, where we share with you about getting started with FSMOne. So during this session, we'll cover topics that will get you familiarized and up to speed with FSMOne, and also help you understand how to make good use of our suite of features and services that are available on the platform. So joining us today is Catherine Tra from our investment advisory team to delve into this topic. So without further ado, let us welcome Catherine.
Hi, Sarah. Thank you for the introduction. So yes, my name is Catherine. I'm from the FSMOne Investment Advisory team. So without further ado, we will start this webinar. So the agenda for me today is actually really to introduce you FSMOne platform and how you can actually make use of it for all your investments, and also some of the tips and also some products information that you may find helpful on our website, and also some tools that are available. So if along the way, if you do have any questions, you can just type them inside the chat box below, and me and my team will actually assist you later and get back to your questions. Yeah, so just to start, this is an introduction on FSMOne. We are actually formerly known as fundsupermart.com, and our company was incorporated in year 2000. So we are a DIY platform, and we are the B2C division of IPOS Financial Private Limited. So one of our key milestones is definitely being listed on SGX main board in year 2014 December. So over these years, we have expanded our business to Hong Kong, Malaysia, India, and China. So our group's asset under administration, AUA, has actually grown to 16.11 billion as of end March this year. So we have increased the accessibility of investment products to retail investors as well as institutional clients, and we have also claimed many prestigious awards. So our presence in the financial industry today is definitely recognizable, and also with the same goal in mind since year 2000, we are always looking for the best investment ideas so that our clients can invest globally and profitably. So as mentioned, we are a DIY platform. You can access all these products that are on our website. So we will consolidate all your investments under one roof. So you will see a top-down view of all your investment and rebalance your portfolio accordingly to see if you are too much into stocks or is it too much into bonds. And because everything are done online, all are actually recorded through the online e-statements. You can see the exact price, units, dividends collected, the fees over the years, so on and so forth. So it's a very good way to actually keep track of all your investments without logging into like multiple platforms, remembering multiple passwords, to just have a quick glance of how your investments are doing. Yeah. So to actually be successful in your investments, it's actually important to have a roadmap to know where you are actually trying to invest, what are you trying to achieve, and then build a portfolio around those investment goals. And also having a very sound investment strategies, like to review your portfolio regularly, or to actually take profit, cut losses, rebalance, so on and so forth, would actually bring about a more successful investment. So it's easier said than done. I will share more over the next few slides. Okay, so first and foremost, before you build a portfolio, we have to actually understand that there's a risk between risk and as a trade-off between risk and reward. So investments that tends to generate higher returns will always come with a higher risk. So be it a potential loss of your principal, or like you see a portfolio declining drastically during weaker market conditions, such as COVID or global financial crisis, and so on. So the higher the returns given to compensate the investors for the risk that they are taking. So always remember that there is no best investment in the world, because one man's meat is another man's poison. So the best investment in your portfolio is something that's able to achieve your expected return within your risk tolerance. So knowing your risk appetite is important, because this would determine how your asset allocation strategy will be like. So factors like risk tolerance, investment horizon, your goal, all this would narrow down the type of investment products that you can consider. And lastly, it's also very important to set aside your emergency fund before you invest, because no one can predict like an emergency and when you should actually need to dip into your pool of funds. And the last thing you want to do is to actually start selling all your investments when they are actually loss making or when markets are weak. Yeah, so based on your risk profile on all these factors, right? It can actually be determined like how much you should actually invest into like bonds or stocks. So this slide shows like a typical neutral allocation of a strategy that is not in an expansionary neither in a contractionary phase. So based on your risk profile, we will suggest to add like maybe plus 10 or minus 10%, plus minus 10% from each of these asset classes in different market conditions. So, for example, if you are a balanced investor, you can invest in a neutral economic environment. You can invest like 50% into bonds and 50% into equities. But in maybe a bull market, you want to actually capture more upside, you can put more into equity. So we will adopt a plus 10% of the equity. So 55% into equities and remaining 45% into bonds. So on the right hand side, if you have the account, you can go into the investment advice under investor profiling. We'll ask you some questions and they will actually narrow down the risk profile for you. So at FSMOne, we actually advocate diversification as a strategy to mitigate abrupt market swings via a portfolio concept. So it comprises of both bonds and stocks. So based on the current economic climate, we would suggest to adopt different weightage into different subsectors because different regions experience varying economic growth, and a globally diversified portfolio would be able to bring about benefits from global economic growth without concentrating your investments in a single asset class or a region. So if you were to look at this quilt of asset chart return, it can be seen that historically they've shown that there's no asset class is the top performer of this chart constantly. So even in like years, some assets could be the top performing class and it could actually come, the bottom for the next couple of years before it starts going back up. So you just want to keep your eggs, not all in just one basket and spread it out as wide as possible, of course. Yeah, so we would like to imagine the investment portfolio like a soccer team. So equity funds are like your midfielders. So and bond funds will be like your defenders. So for your very high risk investments, like single sector, single country, or even stock picks, we will consider them like the strikers inside your portfolio. In your soccer team. So the strategy here is to actually cover the entire field because it will be very risky if you only play with strikers without defending your goalposts. And also, you also cannot be too defensive because you can't score goals if all your players are defending and not attacking. So based on the model's portfolio allocation, which you can find on our website under manage portfolio under the fact sheets there, we will actually show you a rough gauge of how much should be actually invested based on the different risk profile into that segment at this particular point in time. So going on, some of the investment strategy that we will recommend clients to adopt is to actually regularly review and rebalance your portfolio. So just like managing a soccer team, you have to review your players' performance. Are they up to speed, or actually you need other players? So it's important to actually take profit and also cut loss when necessary. So that should one of your portfolio actually outperforms and it becomes a very huge percentage of your allocation now, it will be good to actually reallocate such profit into other segments that could be undervalued. Yeah. So another strategy we always recommend client is to actually do a dollar cost average strategy. We call it DCA because markets don't move up in a straight line. So by adopting a regular savings plan through DCA, right, it will allow you to dollar cost into your investments. So you set aside a fixed sum of money on a regular basis, it allows you to buy more units when prices are low and lesser units when prices are high. So deploying the monies periodically, it will also help you to remove emotional stress and also smoothen out the returns in the longer run. So in this way, you can always be sure that you will never ever be invested at the peak. Yeah, so the last point, of course, is one of the more popular questions that we always get from our clients here at Fund Supermat is that whether is this a good time to invest? So I would think that trying to time the market and to predict the next opportunity or the directions of the market would be actually a fool's errand, because it's nearly impossible to get it right 100% of the time consistently. You have to get the buying correct and the selling correct. So, when markets are weak, and especially after a sell-off in the market, like what we witnessed last year from COVID, seeing your portfolio value decline drastically often results us in doing like emotional decision, like emotional selling, or so on. So I do think that staying invested is really more important than knowing when to invest. Yeah, so after learning through some of the basics to investing, let me just go through some of the investment products that's available on our platform. So I'll just go through the first one. This is stocks, which is one of the more popular investment products here. This is actually commonly known as equities. So investing in a stock means that you are a shareholder of the firm and you own an equity portion of the company business. So public listed companies can be traded on exchanges, and fundamentally the prices are determined by like forces of supply and demand, and there are also other factors that affects the security of the affects the price movement of the securities, like company specific news or the general state of economy, investor sentiments, and even Elon Musk tweets also can actually affect your stock prices. So how you actually get gains from your returns, from your investments, is actually through like capital gains or dividends. So when company generate profits from their business, they will distribute a portion of their earnings to shareholders as dividends. So as long as you are invested in that stock prior to the X date, you'll be entitled to the dividends on the declaration date. So do note that these stocks that usually declare dividends, those are actually not a guaranteed payout, and the payout may be reduced or even suspended. So let's take, for example, Disney shares. They have actually stopped paying dividends in year 2020, and till date, they have still not resumed their dividends yet. So for companies that are more growth centric, they may actually return most of the profits and redeploy the monies into acquisition, R&D, and other expansion plans. So for example, Amazon or Tesla. So for growth company, capital gains will only be realized if you are selling your investments, because they don't pay dividends to shareholders. Yeah, so one of Warren Buffett investment philosophy is that investors should only invest in what they know. So if you have the understanding of how the company derives its revenue, understand its competitors and opportunities and also risks, then go ahead and dive in. Such information can actually be found in the company's annual report. You can look at their financial reports or even other related corporate announcements or articles. Yeah, but long story short, there's actually no shortcut to investing. So it's very important to do your own due diligence, know the company, understand why you're investing. Yeah, so don't get too hyped up in a moment to just buy a meme stock just because it's very popular and all your friends are investing in it. So on FSMOne platform, you can trade in stocks that are listed in Singapore, Hong Kong, and also US. And we are definitely proud to say that we have one of the lowest trading fees for SGX. So regardless of your trade size, all clients actually enjoy a flat trading fee of 880 Sing dollars. And for Hong Kong and US markets, transaction is only at 0.08%. And for selected SGX stocks, investor can also use their CPF OA or even SRS to invest as well. Yeah, so using our platform, you will be able to participate in stock IPOs or even be alerted for any corporate actions on your invested securities. So you may choose to opt in for scrip dividends, participate for AGM, rights issue, so on and so forth. Everything is just done online. Even our CDP linkage form, you can actually link with your CDP account, and we will help you to sell your shares through your the CDP account at the same attractive rate of 880. Yeah, so to spin off some investment ideas, our research team has also created a list of stocks within the thematic portfolio, which seeks to identify and also to capitalize on long-term mega trends that will drive tomorrow markets. So like some of the trends we have shortlisted includes like aging population, China urbanization, millennials, digital consumption, smart cities, and so on. And also for income investors or growth investors, there's also a portfolio for this team. And I briefly mentioned a few stocks in this slide. So you can actually head to our website to find out more about the different teams. And do bear in mind that the portfolio cannot be invested as a whole. You have to actually buy the shares individually. So moving on to the next product, this actually has been a very popular investment product recently. It's actually called the exchange traded funds. We call it, as in the long name is the short form is ETF. Yeah, so do you know that ETF was actually introduced almost 3 decades ago in 1993? So just like unit trust portfolio, ETF are also a portfolio of investment products that can be traded like stocks on the exchange. So you can buy, sell on the same day, make profit. Yeah. So, but for most ETF out there, they are actually passively managed. So this means that the fund manager don't do any cherry picking. Their main aim is to copy the underlying index. So without this active manager, the management fees are also a lot lower. There's also higher transparency because ETF are actually required to publish their investment holdings daily. Yeah. So on our platform, same as stocks investment, you can invest in like Hong Kong, Singapore, and US exchanges. So you can either choose to invest a lump sum, or you can do a dollar cost averaging strategy by subscribing to this regular savings plan. We call it RSP here. Yeah, so there's actually no minimum commitment period for the RSP. You can terminate anytime you want without penalty. So similar to stocks, the lump sum trading fees are actually 0.08 for Hong Kong and US, and for Singapore, it's a flat trading fee of 880. So currently, there's an ongoing promotion for the ETF regular savings plan. There's actually we are actually waiving off the monthly subscription fee instead of the 0.08% every month till end of this year. So personally, I've also picked up a few ETFs to start my RSP on because this is a very, very attractive offer. Essentially, it's a free of charge investments. Yeah. So, of course, before you invest in an ETF, we have to know what is it and also what are some of the factors to consider. So, in the next few slides, I will actually explain some of the factors you should pay attention to and what you should look at. Yeah, so first and foremost, one of the more important factor for ETF investments is its expense ratio. So this expense ratio is actually expressed in a percentage term of the fund's operating expenses to its total assets. So the lower the fees, it translates to a higher return to you. It's also very important to compare it within very similar asset classes or markets. So for instance, over here, I shortlisted three different ETF. All three of them, they are all tracking the S&P 500 index. So first one is by Vanguard, which is VOO. And the second one is by iShares. The stock code is IBV. And the third one is by State Street. The stock code is SPY. So if you can actually have a look at all three of them, the one that actually has the lowest expense ratio is actually VOO and IVV. So you can see they are actually a lot more competitive compared to the State Street investments. And also, ideally, an ETF they should mirror an index perfectly, but there are actually a number of reasons why there's a number of factors that affects them from doing so. They cannot copy it like a mirror image. So, the difference between the index performance and the ETF is actually known as tracking difference. So this problem exists because there are also fees that are incurred from the ETF itself. So like example, transaction fees, rebalancing costs, representative sampling, hedging costs, etc. So the wider the difference, it also means that the ETF is not tracking the index as effectively or efficiently as its peers. So over here, I've shortlisted again the same three ETF, the Vanguard, iShares, and also State Street. So if you were to compare it in the chart, right, on the third row, you can see that SPY actually has the widest tracking difference of 3.4% compared to its peers. So typically, you can also download such info from the ETF fact sheet, especially from the product provider's website. Which will also show you what's the tracking difference between the ETF and the underlying index. So to conclude this slide is that we want to select something that has the smallest tracking difference, so that it can actually duplicate the index more seamlessly. Yeah. So the next factor on knowing the ETF is to actually understand what is the underlying index that you are investing in, because the index that you are investing in will tell us the constituents and also the asset segments of the markets that it's trying to replicate. So for each index, they have its own selection methodology. So these are rules that determine which assets will be in the index or it will be excluded from the index. So as such, right, your money will be actually invested accordingly to the composition of such index and impact your overall returns made by such an allocation. So let's say, for instance, we look at the STI index, the Straits Times index. It tracks the top 30 companies that are listed in SGX. But actually, do you know that 42% of the index is actually made up of our three local banks, your DBS, OCBC, and UOB. So it also means that for every $100 that you actually invest in STI ETF, more than a third of the portfolio is actually invested in the financial sectors and concentrated within the three local banks. So if you know the underlying index, it will also shed light on the types of security you are being exposed to, and if it's actually too concentrated. So for the ETF to actually replicate the underlying index, the ETF can be can do a physical replication, or they can use like synthetic options. So physical ETF means that the fund directly holds securities that makes up the index. So sometimes due to liquidity constraint, or there's too many numbers of holdings inside the index, the ETF might actually do a partial replication instead of a full replication. So the ETF will hold a selective basket of index constituents that best represents the index itself. So the second type of the ETF is the synthetic ETF. So these are ETFs that invest in financial derivatives like your swaps, excess products like participatory notes, with the aim to actually produce the performance of the index. So in other words, these synthetic ETF don't actually hold assets in the index itself. So investors could be actually exposed to like counterparty risk or greater tracking error. So this is a type of structure more common for indices that the ETF that tracks indices on very restricted markets, or they cannot be replicated directly. So for example, buying barrels of crude oil or other commodities. Yeah, so usually you can find this information, whether it's a physical or a synthetic ETF, inside the product highlight sheet, or if not, in the prospectus of the ETF. So usually for me, a shortcut would be actually to refer to our website. On the product landing page, you can look at the right hand side of the slides. We actually do have this type that actually already filtered for you, whether it's a physical or a synthetic one. So you don't need to go through the trouble of digging through the product highlight sheet and prospectus. Yeah. So because there are more than 3,000 ETFs on our platform, a good starting point for investors, especially you're absolutely new to ETF, is to actually refer to our ETF Focus List that's actually created by us. So this is a list of ETF that are refreshed every year. We have categorized them into broad asset segment classes like equities, fixed income, supplementary portfolio like tactical plays, and even commodities. So like for instance, tactical plays will include ETF from like Chinese financials, real estate, cloud computing, semiconductors, etc. So when it comes to the selection methodology of the ETF, we also take into qualitative factors like the choice of the index, structure of the ETF, and also quantitative factors like expense ratio, tracking difference, liquidity, AUM, and so on. Yeah. So for a quick overview of the top 10 holdings of the ETF, I will also go to the view details under our investment info tab. So let me just show you on the next slide. Yeah, so under the investment info tab, right, you will be able to see the top few holdings of the ETF to know what you are exactly investing in. So for instance, this ETF, it shows, it also shows you the historical dividend information and also what is the frequency of the dividend payout. So I think a thing to actually take note is that, there's actually withholding tax on US listed securities. So be it you're buying US stocks or US ETF, US listed ETF, you have to actually pay withholding taxes. So for Singaporeans, you have to actually pay 30%. So in other words, if you are entitled $100 worth of dividends from this ETF, you will only receive $70 after paying the tax. Yeah, for Singaporeans wise, because we are all not US citizens, you do not have to pay capital gain tax. Yeah. So for more sophisticated investor, if you do have a specific sector or parameters that you want to actually filter, you can use our ETF Selector Tool. It helps you to filter the specific segments or even currency exchanges, or even to see if they are CPF or SRS approved. Yeah. So moving on, for unit trust investments, so they are also similar to ETF. They are also made out of investment products like stocks, bonds, money market instruments, so on. So they but for this case, they are actively managed. So the funds do not track any specific index or benchmark. They are actually very flexible to modify their weightage and selections of the portfolio based on each fund house strategy or outlook on the market. So depending on the fund's manager's decision, they can actually choose to have more dividend oriented fund or growth oriented fund. So for instance, if like dividend focused funds, they will tend to include resilient companies that can pay sustainable dividends, while growth focused fund will tend to buy more into companies that maybe pay lesser dividends but do give the investor more capital appreciation in the long run. So unlike ETF, unit trusts, they are actually unlisted. So there's only one price in a day and everyone will buy and sell at that same price. So you cannot buy in and out on the same day, not like ETF. So the benefits of investing in unit trusts, of course, it includes diversification, given that the portfolio are also invested in a pool of securities. So because the funds are actively managed, the investment professionals will actually identify opportunities and also deploy capital as per their strategy and plans. And also for those that for those funds that pays dividend, you can actually reinvest your dividends and also convert them into more units of the fund. And in the long term, when the NAV rises, so will be your returns can be compounded as well. So at any point in time on our platform, you can also have the flexibility to choose to receive dividends in cash instead of in units. So I've summarized some of the benefits as to why people invest in unit trusts. So not only they are actively managed, they can also start with a very small investment amount. investors can even use their CPF or SRS monies to invest as well. And some funds, they do actually provide this currency hedge option, whereby it aims to actually reduce the fluctuations of the underlying currencies and the investment currency and the portfolio currency. So this reduces the FX movement in the portfolio, affecting your returns. Yeah, so on our platform, there is actually zero sales charge for all these unit trust investments. So it means the full amount get to be deployed into the fund itself. So like I said, not like ETF, unit trusts are actually unlisted, so they cannot be traded day to day. So there's only one price in a day. So I mean, one of the downside is actually you lack that transparency, because you cannot see what is the full investment portfolio of the fund manager at any point in time. Typically, we will only see what is the top 10 holdings of the fund. Yeah, so because unit trust investments, there's also thousands of them. We have also created this list of funds, also categorized by the different asset segments. So through the recommended funds list, they are all chosen based on merits, not because they are sponsored or anything like that. So we include different qualitative and quantitative factors to compare to its peers. So for instance, the quantitative factors we'll look at are like the consistency of the fund's ability to deliver returns, and also the expense ratio for which investor pays for the management expertise. Is it too high, or is it worth the risk compared to others, its peers? Yeah, and also for risk factor, we not only look at standard deviation, but also to focus on how well the fund actually holds up during periods of very high volatility. So we also look at the maximum decline in a period of time, and also measure its downside volatility compared to its other peers. So other qualitative factors we consider includes like the fund's manager consistency in its investment approach, or if there's any departure of key personnel in the team, and also the stability of the team as well. So I do think that this list would be a good starting point for investors, and it is actually refreshed every year. You can even click on this thing called the View Fund Write-Up to actually read the review on why we actually like this fund compared to its peers. So more on our website is that for each of these funds, you will be able to see the actionable buttons on the product landing page. So you can view like historical performance of the fund, the dividend information, like how many, as in how much dividend per unit are they paying. So one of the functions that I use the most is actually the fund fact sheet, because this actually shows you where what are the top few latest holdings of the fund, and sometimes the fund manager may include their own commentary within this fact sheet as well, to let you know how's their investment strategy like and all. Yeah, and also, of course, product highlight sheet is very important because it highlights all the key investments risks, and also it jots down the details of the fund's trustees and its other fees. Yeah, so another of the actionable button that you will see on the product landing page, right, is this thing called the chart center. So when you click on the chart center, it will actually allow you to compare the performance of fund A versus another fund B, and it also allows you to compare the difference in performance between the fund and a specific index that you actually want to know. So for instance, over here in this chart, I have selected this Nikko AM Singapore Dividend Equity Fund. So this is our recommended fund for Singapore equity exposure. So I actually plotted it against the Singapore Straits Times Index, STI Index. Sorry. So you can actually toggle the performance to see all the different years, to see what's the volatility like, and also the annualized return. So the lower the volatility number, it also means that the fund is less volatile compared to the other fund. Yeah. So how you can read the chart is that if you had invested $100 in both investments, that's how your $100 would have actually fluctuated and how much it will be worth today. So another tool that we have similar to the ETF selector is that we have this fund selector tool. You can shortlist the types of fund, the payment method. Like example, you can set like financials or like tech funds in a selected currency, and whether or not it pays dividends, so on and so forth. And you will be able to see a list of them. So if until now, if you're still very lost, don't worry at all, because we have this thing called the portfolio advisory service online. You can just log into your account and actually fill up your risk profile, and then we will actually get back to you on some of the portfolio which you can consider and to find out more. So another product that we do have on the platform is actually bonds. So what are bonds? Basically, bonds are loans issued by government or corporation. So investors like ourselves, we are actually the lender. We are lending the company investments, as in monies lah. So in return, the companies will actually pay us interest over a fixed rate over a predetermined period of time. So such an interest collected is better known as coupon. And at the end of the maturity date, the investor will get back the principal amount of the bond. And during this period of time, they can actually earn from the coupon that are actually paid by the issuer. So bonds are often used as like a portfolio stabilizer, because movement in the prices of the bonds are not as volatile, especially for investment grade bonds, high investment grade bonds. And also ultimately, the prices of the bonds are usually tagged to the issuer's ability to pay its debt and also not default. So it's definitely a lot less volatile than its shares. So generally, these are the types of bonds available on our platform. If you do not have a huge investment amount to start with, we will typically recommend retail bonds, because they can be invested as low as 1,000 Sing dollars onwards. Yeah, so for more sophisticated investor, you can consider investing in wholesale corporate bonds, or even invest in Bond Express from a smaller investment amount from just 5K onwards if you are an accredited investor. So I'll share more about Bond Express later. So I'll just start off by sharing how to actually read a bond. So normally a bond is actually quoted like that. First, it starts with the ticker, then followed by the coupon, and then the maturity date, and also the currency. So right, in this case, this is a bond issued by Singapore Airlines. So the bond ticker is SIASP. And the coupon rate of the bond in this case is 3.16%. And maturity date will be the date that is actually fixed on the bond itself. So some bonds could be perpetual, and some bonds actually have a fixed maturity date. So it will all be actually stated in the name of the bond itself. And also, if you see CORP, CORP, it just stands for bonds that are issued by corporations. So you can also have bonds issued by quasi-sovereign or like government bonds as well. And lastly, the one in bracket is, of course, the currency that the bond is being traded in. So in this case, this is SIA bond traded in Singapore dollars. So the minimum amount to invest in this bond is 250K, because this is a wholesale corporate bonds. So when you're investing in bonds, be it the wholesale or the retail bonds, the price that you actually have to look at is this ask price, because when you're buying, you always buy at the ask price, and then when you're selling the bonds, you look at the bid price. So all these prices here, those are actually shown based on the indicative offer on the secondary market. So for example, this buying price is 103.656. So in such a case, we call this bond trading above par, because par value is actually 100. So in other words, you are paying a premium to actually buy this bond today, because on maturity date, which is in October 2023, you will only be getting back 100, even though you paid 103.656 today. So on the other hand, if let's say you had invested into this bond when they IPO back in 2018, it means that you can sell your bonds at 103.231 today. So in other words, you actually made a capital gain. For every $100, you made $3 and $3.23. On top of that, you also had collected the 3.16% coupon since the first day you invested, which is in 2018. So you can actually find a lot more information under the bond information page or the bond calculator. So on the bond information page, one of the info that I would take a look at is the issue size. It just shows you like how liquid the bonds would be and how much the company actually borrowed for this particular tranche. So a ballpark number would be something that is less than 100 million are technically harder to liquidate or to buy because they are considered less liquid. Whereas issuers that issue more than 100 million, typically these bonds are considerably more liquid than the others. Yeah. So, but sometimes this might not always 100% be the case. So, for instance, like Perennial, before they were delisted, they also issued a couple of bonds, but a lot of the bonds were actually taken out by insiders. That means the management from its own company actually put monies in the bonds. So typically, you are those insiders will actually not be trading the bonds, so it's harder to find liquidity on a secondary market. So another information that we also look at is the credit rating of the bonds. So there are three main credit rating agencies like Moody's, S&P, and Fitch. So these three rating agencies actually rates the companies and the bonds on their ability to actually carry out the financial obligations. That means to pay up for the bonds, pay for the coupons, and so on. So if you do see like NR, on our website is actually just means not rated. It does not mean that the bonds are actually very inferior compared to other bonds. It just means that the company did not actually pay the rating agencies to rate them. Because it's actually not compulsory for companies to rate their bonds or the companies. But typically, if companies that are issuing in like hard currency, they will typically go for rating. But for companies that are issuing in the Sing dollar space, they will not usually go for rating because first and foremost, it's like a double-edged sword. If you go for rating and if the rating companies rate you very badly, you have to actually pay a lot higher in terms of your coupon. Yeah, so for usually Sing dollars bond space with their local presence, investors will be more or less familiar with the profile, and hence they will not actually have to go for rating at all. Yeah, because a very poor rating, like if you get a single B or like a triple C, it also means that it's a higher borrowing cost for them. So, for instance, SIA, Suntec, Starhub, Sembcorp, OUE, Google Land, all these are actually not rated at all. So you will see NR on the issuer on the bonds credit rating. So as a guide, if you do hear like investment grade bonds, typically they just means anything that's rated triple B minus and above. So all these are investment grade bonds. It also means that they carries a lower risk of default. So typically bonds within the IG space are considerably a lot lower in terms of the returns, the yield per se, compared to those high yield bonds, which they are non-investment grade. So on the same tab, you also can see the sonority of the bonds itself. So this represents the hierarchy of the claims in the event of liquidation. So most of the bonds issuance will fall under this thing called the unsecured debt. And also for perpetual bonds, they are typically ranked a lot lower than the fixed dated bonds. So the higher up in ranking, it means that there might be a higher recovery value in the case of bankruptcy or liquidation. So equity, right? Which we all know as your common stock, they are actually ranked the lowest. So for perpetual bonds, typically they are actually considered subordinated debt. So it's in between the unsecured and the common equity. Yeah, but I think for certain bonds, like example, those issued by Wing Tai and Singapore Post, even though they are all perpetuals, they are considered they are ranked pari passu to those fixed dated bonds, so they are not subordinated. Yeah. So another tool that I also use often is this bond calculator. So basically, bond calculator will help you to gauge what's the annualized yield of your bond investment based on the current bond price. So right next to the yield to maturity, we call it YTM. Right next here, you can actually see the net absolute return. So this number is actually a non-annualized figure compared to yield to maturity, which is always displayed in an annualized figure. So if it is a perpetual bond, so just do take note, do not refer to any of these numbers. Because perpetual bonds, it'll be more accurate to actually look at the yield to next call or the yield to worst. This means the worst possible yield to actually be derived from the bond itself. Okay, when it comes to selecting a bond, I think one of the most common pitfall that our investor have is actually to start comparing the coupons rather than yield. Right now, it's like we are not actually investing in like stocks, where you compare the dividend payout, but rather we have to compare the yield, which factors the price of the bonds today and also the yield to maturity. Because in different economic conditions, the issuer will actually issue at a different coupon rate. So you cannot just look at coupon itself when investing in bonds, because those bonds could be issued during periods where interest rates are very low compared to somewhere where they issue a bonds where interest rate were a lot higher. So for most of the bonds, coupons are actually fixed for the entire lifespan of the bond, and it never ever changes. But some of them, some coupons could also change according to the reset rate or other clauses within it. So it's more accurate to actually look from the yield perspective. So a ballpark would be like, as in a general guide would be the lower that you pay for the bond price today, it also means that it will generate a higher yield for you. So in this slide, I've actually illustrated like 3 different examples, the different scenarios where, you invest in a 2-year bond with a 5% coupon rate. So the first scenario is where you actually buy a bond when it's trading at par. At par means that you are buying it at 100. So if you are holding it for, let's say, 2 years, so in 2016 you buy, and then 2018 it mature, it also means that you do not have any capital gains at all. It's $0 capital gain, but you do gain a coupon of 5% every year. So your total yield will be actually 5% because that's only the coupon. Then the second scenario is when you are actually buying the bond at a discount. Discount means that instead of trading at par, which is at 100, right now the bonds is trading less than 100. So for example, if you buy the bond at $90 in 2016, and when it matures in 2018, so during this period of time, there will definitely be a capital gain for $10 every $100 invested. Yeah, so your capital gain will be 25K in this case, and then your coupon gain would also be the same, which is 5% a year, and your total gain will be that 25K plus that 5% coupon, and your bond yield will be more than 5. Yeah, and then the last case is actually the reverse, whereby your bonds is actually trading at a premium. That means you are paying a lot more for the bonds today compared to how much you will actually get back upon maturity. So in this case, there will be a capital loss. But if you include your coupons that you have clipped along the way, your total gains would be, there will still be gains, but definitely less than 5% per annum. So so there's also another common misconception is that I should just buy the bonds before the coupon date so that I can get the full 6 months worth of coupon, right? When it comes to the coupon payment date. So unlike stocks, right, investing in bonds, there is actually very much fair and square. For stocks, you just have to buy before the X date and you get to clip the entire coupon, whether is it 1 day before the X date or 1 week before the X date. But for fixed income bonds investment, when you are buying the bond on the settlement date, you actually have to pay this thing called the accrued interest, because the previous note holder who is actually giving you this bonds, right? The previous note holder will not be taking the coupon at all because the bond already belongs to you. So you have to pay back the previous note holder the interest that is actually due to him. So on the coupon payment date, yes, you will collect the full 6 months of coupon, but if you less off whatever that you had paid for the previous owner, essentially you actually only earn the difference. So in other words, it's very fair and square. So regardless you buy 1 week before the coupon payment date or 1 month before the coupon payment date, the accrued interest would actually change. So this is just an example on how you can count what is the accrued interest payable. Yeah, but if you do have, if you face a lot of, too much calculation to do, right, you can also go to the same coupon calculator. We actually help you to indicate, like, roughly how much accrued interest you have to actually pay up for this bond. So as mentioned in the earlier slides, if you are an accredited investor, you can actually invest in a wholesale corporate bonds through the Bond Express platform, which is exclusive to only FSMOne. So this allows you to build a very diversified bonds portfolio instead of investing like 250,000, a quarter million into a company per bond. You can actually just invest 5K into these companies, because we actually break up into smaller sizes for you. So right now with 20K, you can actually invest in 4 different companies, compared to usual you have to actually have 1 million of investment capital. Then you can buy into 4 companies bonds. So over on the next slide, I'll just show you how I actually constructed a portfolio based on the bonds that are listed on Bond Express. So here's an example. So in this example, I use a Sing dollar denominated bonds. So some of these bonds, they are all found on Bond Express. So issued by Wing Tai, OUE, Escort, Cathay, Olam. So all these, we have also covered their credit analysis in our bond ideas, and in fact our recommended bonds booklet. You can actually have a look at them as well. So this is where you actually find more write-up on these companies. So you can go to under research, under recommended bonds, and under the report here, you will be able to download a PDF. So I do think that we do cover quite a good number of bonds, over 50 issuers, and it's actually published every half a year. So to just have a quick idea on, what this company does, or like, why you should consider such a bond and the credit profile, you can go in to have a look at more of the information. So because we are also a DIY platform, there's also the same bond selector, and also the fact sheet where you can have to look at all the information. We also have like this request for quote feature, where you can actually ask for the quote of the bond price traded on the secondary markets, because bonds, they are not like stocks. You actually do see the price movement minute by second by second, but for bonds, because they are traded OTC, over the counter, it's actually less transparent, and it's also pretty opaque. So our platform, we actually aims to eliminate such opacity and let you connect to our dealers directly to ask them for the live price of the bonds, and you can just talk to them using the request for quote function. Yeah. So on our platform, we also do have a team of analysts that actually do weekly updates on the fixed income markets, and also investment ideas for bonds. So you can actually read more about it on our website. Yeah. Yeah, and of course, you can participate in IPOs as well. So you can sign up for SMS or email free of charge under the subscription there. You can be alerted ASAP when a new bond is out. And also, if you do have Telegram, you can actually join us on this Bond Supermart for actually more news that we actually publish. So you can look at it from a bite-sized point of view rather than checking your emails or reading through all the newsletters. Yeah, and also lastly, if you like listening to podcasts, you can go look for this thing called the You Hunters. We are available on iTunes, Spotify, and Google Podcasts. So we do have special guests occasionally to actually discuss more about the ongoings in the fixed income markets. So after actually going through so many products for almost the last 1 hour, right? So if you're still very confused, just fret not, because we do have this thing called the managed portfolio. It just means that we are actually doing the homework for you and investing on your behalf. So we do have a team of dedicated portfolio managers and also research analysts that studies the full spectrums of your unit trusts and ETFs that are available, and then we will select the best investment products for your portfolio, and we will monitor them daily, digesting all the global financial and economic data event, and also leverage on our regional research team for in-depth analysis. Yeah, so unlike other robo advisories out there, this managed portfolio actually consists mainly of of unit trust investments rather than ETF. And also, we do not use our algorithm to actually rebalance the investments. There's actually more of how do you say, research actually done to actually back our every decision. So valuation driven approach, looking at price earning, price book, and other data. Yeah, so investors don't actually who do not actually have time to actively monitor their investment, who are very new to all this investment. This is a very quick solution to actually get started. The minimum investment amount is just only $1,000, or you can set up a regular savings plan as well, and it just starts from $500 a month, which you can terminate at any point in time, and there's no commitment period at all. Yeah. So on a quarterly basis, you can also actually look at the webinars that we conducted to actually tell you, like, the changes that we have made in the portfolio, and also how we will actually be positioned moving forward. So one of the last few products here is actually the cash management solution that we have on FSMOne account. So basically, this is like your trading wallet. You can actually store various currency inside the multi-currency account. So you can put your Hong Kong dollars, Aussie, US dollars, Sing dollars, all inside this account. And dividends that are actually collected from all these stocks, ETF or bonds can actually be kept in their own currency as well. Yeah, and all these actually do use some basic interest. You can find out more on our website. And also, to take things one step further, we also introduced this thing called the Auto Suite account. So this is where FSMOne actually manages on a discretionary basis for you. And you can actually opt in and deposit Singapore dollars in this account and earn a net projected yield of 0.586%. So monies that are kept in this account can also be used to pay for all your investment products without any lag time. So your sales proceeds, dividends, income that is collected in Sing dollar will also automatically be swept into this account to actually get a higher yield, rather than always monitoring to see when the monies are coming in and trying to withdraw it and to put it in a higher yielding account. We just do that automatically for you. Yeah, so in such a very low interest rates environment today, you might be actually wondering how we actually give such a yield of 0.586%. So our secret is actually in the next slide. So when you top up the money into this account, right, we actually manage the monies here. So you can see, instead of keeping 100% in cohort cash, we only keep 15% of it in cohort cash. The remaining 85% of them, we actually invested in all other money market funds and short duration bond funds. So all these are very safe segments of the fixed income markets, like money market funds, for instance, the Fullerton SGD Cash Fund. They actually just take your Sing dollar and put it in various bank short-term fixed deposit. That's all. It's not even into any investment products at all. So the placement period for the funds, they usually place it like less than 4 weeks, so they are very liquid. And also other funds like your Lion Global SGD Money Market Fund. This is and also the Enhanced Liquidity Fund. All these invest in very high quality bond portfolio with an average credit rating of let's say about A, like that, A plus minus. Yeah, and the weighted duration of the fund usually is less than a year as well. So they are very not sensitive to the interest rates environment. So yeah, and like I say, the last 15% of the portfolio is actually safeguarded just in cohort cash. So this is a 4-part composition that forms and makes up your Auto Suite account. So it allows your idle cash to actually compound returns while actually waiting for your next investment opportunities in the market. So the funds are very liquid. You can use it to pay for anything on our platform. Even in a non-Sing dollar product, there's actually no lag time. So if you want to actually use this money to invest in a US listed or US denominated product, you can actually use the funds here immediately, queue for the stocks or the ETF. If it's not executed, your funds will still remain in Sing dollars. And if it's executed, it will just help you to auto convert them into USD. So you need not take the trouble to actually manually calculate, like, how much exactly Sing dollars I have to actually convert into USD for the investment product. So last year, we also have actually improved our mobile app. So it's actually very easy to use, and I do highly recommend you to download it so you can get a quick glance of your portfolio performance, the price of the securities that you have invested and all, and even look at a watch list. So you can actually even click on this research icon to actually read more about our research insights like ETF ideas or stock ideas. So you can download them on the Play Store or like the Apple Store, App Store as well. So on the research tab, you will be able to see like, you know, our rating methodologies, like on each segments, sectors, how we actually rate the markets. So like 5 star, it means it is the market that represents the most attractive market. And currently, right now, our top choices of equity markets is China, Hong Kong, EM, as well as Asia. So the team actually look at like PE, PB, and also expected earning growth as well as excess earning yields to determine like how attractive a particular market is it is like. Yeah. So for more research insight, if you do have Telegram, feel free to just follow our FSMOne research channel. Over here, you can stay up to date with all our investment ideas in bullet point forms. So for those who have very busy schedules and just want to know like what's going on with the markets or like, you know, some of our investment calls, do feel free to just follow us on FSM1 underscore SG, or you can just click on this link here as well. Yeah. And I do hope that everyone has found this short session very meaningful and learned something today. So I know that market swings can actually rattle the most seasoned investor, but I do think it's good to get comfortable with volatility as it is part and parcel of investing. So if you want to have a chat with us on how to actually construct your portfolio or to hear our latest investment outlook or ideas, feel free to actually reach us via any of these channels and we will get back to you.